Right now to talk more about it is Piper Jaffray, Senior Technical Research Strategist, Craig Johnson, along with JMP Securities President Mark Lehmann. Great to see you guys. Thank you so much for joining us.
Good morning.
Characterize the earnings period for us, Mark.
It's a good period. The first quarter is going to be solid. It's somewhat easy comparisons, but up 10% is what investors want to see. I think it puts a floor in the market for now, and I think we're going to have a good earnings report starting next week.
And Craig, you look at the market on a so-called technical basis.
Correct.
You say the charts really support that.
Absolutely. The charts look very bullish. And Maria, when you go out and you plot out the earnings revisions for 2015, 2016, and 2017, what you'd seen in 15 and 16 was a big drop off after the first quarter earnings season and a big step down. Now in 2017, you're not seeing that. Earnings are holding up fairly well, so you're looking for about, 10% type earnings growth for the full year.
That's good, Kevin.
Yeah, one of the things I'm concerned about is bank earnings, and that's because we had tempered expectations from last quarter. They're expected to increase 15% this quarter, but we haven't seen any of the financial regulations. Do you think that could hamper this earnings season as well as the rest of the year, given the fact that they're one of the largest sectors? Tech is leading the way. Tech's growing overseas. There's not that many worries, but the banking sector, we've seen it in the regionals, and so that's of concern for me. Where are you guys seeing this?
That's a good point. I mean, I think 16 obviously was a great year for those stocks in anticipation of the regulation like you described. The earnings are not there yet, so I think there is going to be a little bit of that yin and yang where the stocks are getting a little ahead of the earnings. I think as you go through the year and see more of that relief from some of the regulation, I think the stocks will come back a little bit. But in terms of the performance, I think the stocks are a little bit ahead of themselves.
I would just say from a technical perspective, I'm just watching the 2 to 10 spread. And that's been a pretty good leading indicator for the entire financial sector.
The 2 to 10 meaning the 2-year versus the 10-year.
Correct. And as we see that starting to rise, that's going to be a good sign for banks for their net interest margins. So we're watching that very carefully. I would agree that these financial stocks, they do look like they're starting to correct. When I look at the large caps, the mid caps, and even the small cap names, big surges post the election, and now they're correcting back to a big area of support. More time is required, though, before I really want to step up to those names.
So should we wait until buying financials? Should we be sellers here on financials?
I would stay on the sidelines on the financials for right now. There's a little bit more time for these names to pull back, want to find some support, and then you'll get a good buying opportunity, I think, in the second half.
Mark, with the massive outperformance of tech in the first quarter, with, broadly speaking, a double-digit gain on information technology stocks, do you do a sector rotation here, rotate out of tech and into something that's underperformed, maybe even energy at this point?
Yeah, I think tech obviously has some of the earnings components that we just talked about. They are going to have that kind of growth, and I think there's still that kind of overseas demand. We're at JMP, we're a little more positive on healthcare. I mean, that was one of the sectors that did not do well in 2016. The first quarter was terrible for healthcare last year, yet performance wasn't terrible, at least for the fundamentals of those companies. I think there's a little catching up to do. I was at a life sciences conference yesterday. We were talking a little bit about that market, and biotech was under assault at this time last year. But, there's 3 underpinnings of that market. One of them is, are the companies getting more things in front of the FDA? The answer is yes.
Yeah,
is the FDA is accommodative? The answer is yes.
I was going to say, that's something that can change without a healthcare overhaul.
That is exactly right.
Is opening the door for drug approval and making the process.
That's a policy story.
Yeah, that is a policy story, and I think, Maria, the most important thing when you look there is there's this kind of undercurrent that says that fewer drugs are getting approved and they're getting a lot of non-response letters, complete response letters, which is negative. That's not true. Statistically, we're doing better. The shots on goal are better. That's an underpinning for healthcare we should talk about.
Now, healthcare earnings expected to be up 3.15% according to S&P. That's for calendar year 2017. Look, this market obviously has slowed down in terms of these gains, but you're still bullish on stocks.
Still bullish on stocks. We're looking for 24 by the end of this year, which when we set that price objective back in November felt very high. Now at this point in time, we're getting very close to that. I still see upside to go, but I think one of the biggest catalysts I think is going to be for the market is when we finally start to see rates move higher. And my year-end objective on the 10-year bond yield is for 3 to 3.25. So when you start moving north of 2.75 to 3, you're going to start to get a rotation out of fixed income and into equities, and that's just going to continue to push this market even higher.
So your target on rates on the 10-year, you're looking
on the 10-year
at 3%.
3 to 3.25 by year end.
Are you worried about the price action recently?
It's
compressed now, and that's not a good sign for this economy because we've seen yields come down from 2.5, and they're approaching
the 2.36%.
Right, exactly. It's approaching 2.25.
So what you're seeing on the 10-year when you look at the chart is a nice consolidation between about 230 and 260. anytime you're going to try to take out a major overhead resistance level, you tend to push at it a few times, kind of like a rusty door, and then it'll open, and you'll see a nice solid move.
Like what happened with Dow 20,000.
Exactly.
Next thing you know, right now, 21,000. Hey, by the way, we got to talk about jobs. Jobs Day on Friday. What do you think? Good number?
I think it's going to be a continued trend. I think that we've had a continued ascent on job creation. It's good for the overall market. More people are employed. I think that's going to be, again, an underpinning for the market. And speaking of jobs, today's the 5-year anniversary of the Jobs Act.
Woohoo!
And that, you know, as I like to say, it's the last time the Democrats and the Republicans agreed on anything. They sat in the White House.
5 years ago?
5 years ago today. And we've got 25, by some people's measurements, 25% more IPOs than we would have had without the Jobs Act. We've had
Snap filed under that IPO.
Absolutely.
You're seeing all these technology companies now file under the Jobs Act because the disclosure is less. They're not giving up their secret sauce.
That is exactly right. And that's really, really important, particularly for people who have some things they do not want to disclose. So IPOs are performing well this year. We've had, with tomorrow's pricing of Okta, we'll have 5 tech IPOs versus 0 a year ago. They're performing well. Even ex-Snap volumes are up 10 times what they were a year ago in IPOs. We need more IPOs. It's great for the economy. It's great for the country.
All right, we'll leave it there. Good stuff, guys. Great to see you both.
Thank you.
Thank you so much. Craig Johnson, Mark Lehmann joining us there. We will